All right, guys, you're probably a little sick and tired of all the posts regarding the podcast, which is now up, but I thought we'd return to some education and talk about the tax cuts that are coming up on the 1st of July. And a lot of you are probably thinking that this will just go towards the cost of living, but there are quite a number of strategies that you can utilize to make the most of these tax cuts. And that's what I want to talk about today. So as you can see on my screen, we've got the differences of the different tax brackets, at the same time, the different taxable amounts and what the new tax cuts will be. So as we can see on the right-hand column, with the new tax cuts, you can save up to $4,529. Sorry, guys, it's the end of the day. But $4,529 is what you can save up to, depending on your taxable income. But let's just say, for example, someone earning $100,000, that tax cut's going to be $2,179 next year. So you might want to think about where you're going to utilize this. Is it going to go towards the cost of living? Do you want to look at salary sacrifice? Do you want to put it on your offset account? Or do you want to invest the money? So let's look at a few different scenarios and how they might play out. Now, just remember, guys, all the information that we cover is just general advice only. If you want to see if it's appropriate for you and make sure it's the right strategy, seek professional advice, reach out to our office. We're licensed and accredited financial advisors, and we can assist you in putting together a plan that's going to help you in the long term. Now, let's just look at a tax calculator. So, for example, if we put in the amount here, 100,000, we can see that tax cut's going to be $2,179, which is in line with what it says here. Now, let's just say, for example, we want to get even further tax deductions and we'd like to contribute that extra amount into superannuation. So you want to put that towards your retirement savings because you're getting taxed at 15% as opposed to your marginal tax rate if you're putting that money to super. So for simplicity, I've rounded that figure up to 2,200. If we put that into superannuation, you're going to save yourself another $715 in income tax for the year. And that money is going to be invested. So you're going to get a return on that investment as well. So just be careful about where you are choosing to invest that money. But not only will you get the fee saving or the tax saving, you'll also get a further tax deduction from the saving by putting it into super. Now, let's just say you don't want to hold that money up into super. You'd rather invest it and have access to it if required. You might want to think about investing that into an investment that you've got access to. So let's just say, for example, you decide to put it into a investment, $50 a week. Let's just say on an average return in a high growth investment, which is about 7%. For 10 years, you continue to invest that $50 a week. We're now looking at your initial investment over that 10 years of $26,000 and the return on that $11,500 roughly. So your total is $37,500. Where you've got access to that, just be aware if you pull that money out, there's capital gains tax to consider, but it's also something to help you with your investment journey. One that you might want to consider is by putting that onto an offset account. Now, let's just say we put that initial $2,200 into an offset, and every week with the tax savings that we're getting, we're putting $50 a week into that regular into that offset account. By the end of it, you would have shaved off 4 years and 1 month off your loan, and you would have saved interest of about $174,556. Now, that's at a variable high interest rate there. If we change that interest rate, obviously that's going to change the amount that you have. But let's just say, for example, you've got a 6.4% rate. You're looking at $131,590 in terms of savings there. One thing you might also want to consider is that if you are thinking about potentially selling an asset or selling a investment, you might want to think about selling it in the new financial year as the tax rates have reduced, meaning that you'll pay less tax on an investment when you're releasing it, as you'll be taxed at a lower rate. So you might want to check if your tax rates are changing as well, as they could also save you on the amount. Now, if you do have any questions and you want to double check to see how these tax changes might impact you, how they might benefit you, or you'd like to have a further discussion about your options, you can reach out to our office, or you can go onto our website, rpwealthmanagement.com.au, where we've got case studies, we've got further details about what areas we provide advice in, and you can put a callback request through our contact page, and a financial advisor will reach out to you. Thanks a lot, guys.